Hello everyone, welcome to China Market Connect. The widespread fears on geopolitical risks led to global equity market pullback. The scale has resulted in breaking through some key technical levels and bring potential threats of markets entering a correction territory. Looking back over the last 30 years, there were probably 10 key geopolitical events that caused different level of pullback for different regional markets. What we observed is China, particularly China A-shares equity, tend to be more defensive when global geopolitical risk is heightened. This time round, China, like all the other equity markets, is unlikely to be immune to the volatility, but the scale of sell-off will be relatively less when compared to other markets for three reasons, we believe. First, China has an idiosyncratic nature in policy making. Policymakers in China have not exhausted, not even fully utilized their available tools in supporting the economy. With under-leveraged banking liquidity, underspending for government budget from last year, and trillions of dollars reserve in hand, these are all the options that policymakers can easily tap into in supporting the market if needed be. Second, Chinese companies have a domestic-focused business model and is fueled by millions of customers in mainland China. Revenue generated from overseas are in single digits, around 6 to 8%, according to Wind data. Third, the risk-off appetite is unlikely to result in any sizable outflow from China equity market, as foreign ownership is still at low level, around 4.5%. And broadly speaking, global portfolios are still underweight China by approximately 450 basis points versus its benchmark, according to EPFR. The combination provides reassurance of meaningful retrieve of capital from China equity market is unlikely. Historically, the return correlations between China A-shares and global equities are low, which suggests potentially lower spillover impact from global sell-off. But that doesn't suggest to not acknowledge the potential volatility with China equity market. Currently, most of the country are starting to relax from the COVID lockdowns and resuming full speed into the growth mode. However, with the heightened inflation risks and interest rate uncertainties, that could lead to a potential tightened financial conditions globally. In that context, China is unlikely to be isolated from the challenge, but the degrees may be a low beta scenario's impact for China equities. Even if commodity price continue to rise, the impact on China's inflation is likely to be limited, as China's CPI basket is dominated by food component, and China's import on that are quite limited. Domestically in China, the cross-sector return correlations have reached high level, suggesting macro factors are driving stocks returns. This may continue in our opinion, but will shift to be more on the supportive side. That makes the NPC meeting happening in Beijing this week an increasingly important event to watch in assess macro conditions in China for 2022. Stay tuned, we will cover NPC in the next week China Market Connect. This is Xiaolin Chen, thank you for watching.